Hi there, this is the second so-called Super Thursday in the land of UK monetary policy. Stephen Pope is with us to digest the deluge of data and decisions. Now, Steve, despite some talk of Ms Forbes supporting a rate hike, the vote was 9-1 for a fourth consecutive month. Inflation forecast has been lowered, global growth outlook downgraded. It's not really all that super, is it? What was your main takeaway, Stephen?
I think the Bank of England, like many other peer group of central banks, has recognised that the interest rates low environment and QE has not really delivered the robust growth we thought was going to happen. It's as though asset prices have improved, but not because of an ongoing and continuous burst of economic activity, but more because there's been the opportunity to take cheap financing and undertake share buybacks or to replace old expensive debt with new cheaper debt. So I think that's on the mind of the Bank of England, that the figures superficially look impressive, but is there any real substance to it?
Now, on that note, Carney said the UK economy has shown mixed progress, but real income growth is its strongest since the crisis, and the prospect of rate normalisation has risen since the recovery. Next week, for example, we have the ILO data, but what is the Bank of England really waiting for?
I think that we're in a situation where many central banks, their primary concern is, of course, the domestic economy, which they're meant to administer. But they also have to, in this very open world, bear in mind what's happening in some of their key trading partners. So take on board the figures we've seen recently in terms of Purchasing Managers' Index up to around 44.9. It's showing a good growth in terms of where it's been over the last couple of years. But all in all, they have to be quite biased. Now, the rate hawks will point to some of those PMI surveys on servicing and manufacturing and say this really indicates the need for a rate hike now. However, I think, as you alluded to, the inflationary scenario is so weak, and it's not just in the UK, it's a global basis, that I sense that they will want to hold off at the current time, and I doubt the Bank of England will move before the Fed does.
The MPC isn't worried about losing credibility, apparently, but when asked does the divergence between central banks concern them, the governor said no central bank knows what they are going to do at the next meeting. Is this a case of the central bank trying to claw back control of the market as opposed to the other way around? And do you think it will work?
Well, he came in a blaze of glory and added the extra arrow of forward guidance. And yet some of the timelines he laid out on the forward guidance had literally been blown out of the water. And so in that regard, he is probably trying to row against the tide to bring back a sense of credibility. But it's not just himself alone. I mean, we've been sitting here talking about the Fed would hike rates in US in September of this year. We're well past that now. It hasn't happened. We were talking about what the ECB will do. And I think that many of these central bankers, one, have become aware that they seem to be doing the heavy lifting still in terms of stitching together the fabric of a tepid global economic recovery. I think they all sit and watch very carefully what happens with the People's Bank of China, because their policy will have a significant effect on how the Chinese economy behaves, and in turn that dictates how the mood and market sentiment is. And I just sense that they are looking for, can they extract themselves from this zero rate territory that we've come so used to without destabilizing the fragility of the asset prices that have improved so far. So I sense that the central banks are tiptoeing their way towards better rate structure, certainly in US and UK, but we're not there yet, and we're probably not going to be there until Q2 of next year.
We also learned the MPC has a refined view of the pound impact on CPI. Tomorrow we have US NFPs, but the headline figure may or may not be the linchpin for the Fed's rate decision. What are you expecting from the data, and indeed pound dollar, moving forward?
Well, certainly if we get to the deadline for the data tomorrow from the United States, the non-farm payroll is the normal figure that takes the main headline, and the expectation is 180,000 in October, compared to the initial estimate of 142,000 for September. We'd looked certainly to see what the revisions are, but if that headline figure came in anything at 200 or above, suddenly you'll start to see a fever building up about when the Fed's going to move again. But I also think we have to look closely at the American level of average hourly earnings. We're looking for 0.4 Really, I think that if we could get to that type of magnitude, it would certainly, if coupled with a high reading on the long-term payroll, it would certainly cause the market some disturbance. But what I would sense is that my FX view is I'm long of dollar against everything, and then long of sterling against everything apart from the dollar. And that's working out quite well at the current time. Most of the time signals on the technical basis for sterling dollar are saying you should be selling it. I would think that from this current level, where we're probably around about the 152.5 territory, the next targets for me are down to 151, which is a level seen in early October. If that yields to the downside, then 148, 145, purely because, yes, the Bank of England might move, but whatever they do is in tandem with the Fed. So it's not going to give sterling any advantage against the US.
Stephen, great to hear from you. Thank you. Well, of course, investors now await the US jobs report, but there will be plenty more ups and downs in the meantime, so make sure you keep clicking back to Dukascopy TV. Bye for now.